Congress unanimously passed the CARES Act. At the Fed, we used our powers to an unprecedented extent to stabilize the financial system and help stave off an economic depression. To an unprecedented extent, an economic depression.
Words straight from the horse's mouth as Jerome Powell admits that we have avoided temporarily a depression. And it's not just Jerome Powell. Ben Bernanke, through the great financial crisis and up until 2012, said he needed to do money printing and stimulus in order for us as a country to avoid a depression. And so on top of the layoffs, the overwhelming mass AI layoffs, we're also going to talk about and think about what's going on with the Federal Reserve, because an entire body of work and thought called Austrian economics that is stating that as a result of them doing this money printing, that the problem is just going to get worse and layoffs will just accelerate. So we got a lot going on today, guys. Obviously, I have our community wizard, Mitch Wexler, here with us today to help break down what's going on in the markets with AI, with layoffs, and with the Federal Reserve. And Mitch, good morning, sir. Happy Thursday. How are you, buddy?
Good. It's been like normal, it's been a long few hours here. So
yeah.
Came in about 2 o'clock this morning, and we're still hammering away, but it's all good.
Yep. I'm making a ton of progress with the course as well. I mean, we're going to light them up, man. We're going to knock this system down. 2025 is going to be our year to take it down. So I'm excited. Now, Mitch, let me show the viewers where we're at right now with the market. On one hand, we have Jerome Powell, Ben Bernanke, all of these people saying, hey, U.S. citizens, taxpayer, we need to do this because we are avoiding a depression. So again, I don't get why the bulls are like denying all of this, but I also understand why consumers don't get it, because look at these headlines, Mitch. And again, this is this morning. GDP update shows U.S. economic expansion in second quarter was stronger than initially reported. I wonder if it's from inflation and stimulus. Also saying U.S. economy grew 3% in second quarter, and that's the revised figure. In addition to that, more information came out. Layoffs remain low as first-time jobless claims decline. And you guys can all see this is from this morning. In addition to that, Mitch, trade deficit in goods widens sharply to the highest level in more than 2 years. When we measure the volatility, look at the market. The market's saying there's no volatility, Mitch. Just send it. The VIX is down. The start of the morning anyways, 7.89%. So before we jump into the layoffs, and trust me, we will jump into the layoffs, Mitch, can you give us a quick breakdown on what's going on around the market and why on this Thursday morning?
Yeah, so what you're looking at is exactly what I thought was going to happen, which is I made the case that there could actually be a double top, and it's on its way up, and it's up again this morning. The NASDAQ is up. So it's basically what in the stock market world is called pump and dump. So when Goldman Sachs came out, I, in the last video, explained why they're doing nothing but speaking their book. And more than likely, they will start loading up on puts when we come up to that double top. And that's when things will start breaking down. So yeah, the market is going to do what the market is going to do. But the ramifications of what you're seeing in every single one of those stories is the pump. Under the hood, here's the problem with everything you've just seen, even when they come out and say, well, we took this survey and we took that survey. You have to break it down and understand who's giving the information on the surveys. You want a real survey? Walk into a grocery store and start asking real people, then you get to the truth. Past that, this is a straight pump and dump.
Yeah, Mitch, I don't get why people still trust the market. They still trust the market. They're still, letting the market think for them. Still.
You have to understand that the market's got a job, and the job of the market is price discovery. So they're no different than a politician. They'll lie straight to your face in order to pump it up, knowing full well that the retail traders are going to get screwed on this. And the big boys more than likely are already loading up on different forms of puts under the market. So nobody's going to sit there and just say, okay, we're going to ride this up. I mean, the idea that we've been up, this market's gone up for the last 10 years straight up. And the idea that that's going to continue is a fool's errand. So yeah, you get 23% on the odd year, but do you understand that the market's only made about 14.5% per annum per year on average? So it's not the panacea when they say, well, we're up 24%, we're going to hit 30%. Yeah, it's not true. Go back, just look at the last 10 years. it's only been about 14% a year on an index, right? So call it NASDAQ, S&P, call it whatever you want. It's only 14%. And then to make the matter even more interesting for people, you have a pension fund. So your pension fund, net of fees, only earns about 6.7%. The market's doing double up, and yet you've got your money in a pension fund. You think it through.
We broke down a whole video we're going to make for you guys probably this weekend on that. I mean, it's absolutely beautiful. But the thing, Mitch, I mean, a financial advisor, it seems like to me, a financial advisor or even an economist or literally anyone that's working for a company that's designed to profit off of the public, they're always going to give you advice that, you know, turns you right back around to spending your money. It's literally their job. So it makes sense that literally the whole market is saying buy, spend. You know, there's this whole AI boom. The market exploded, Mr. Like AI is the future. Let's just go. But it actually might be the .com bubble, the new .com bubble, as you mentioned. But I want to show the viewers what's going on right now as far as AI. This article was interesting. The Fed has shaken from its path by a softening labor market and will deliver steeper rate cuts as a result. That's according to JP Morgan. Again, the market is rallying. Why is no one thinking about the layoffs that are going on? Here's another one. I covered this on DNN yesterday. Jack did this story, but Scale AI lays off workers via email with no warning. The reason, guys, they do that is because, remember, these are corporations. They're doing business. If you're involved in a relationship and it's a business relationship, you can't expect them to care about you. And I hate it. You know, anytime, Mitch, someone says it's just business, I hate it. If you ever say that to me, Mitch, you're going to break my heart. Don't ever say that to me, okay? To me, it's always more than business. It's about relationship and about helping people. But regardless, 1,000 people laid off as a result of AI. And it's not just there. When we go here, tech layoffs, massive tech layoffs, guys. Dell fires 12,500 employees, 10% of global workforce, and major shift towards AI. And it goes on. Even Apple lays off, tech giant cuts 100 digital service workers amid big AI moves. It may not look like a lot, but it's happening is the point, and it goes on. IMF official delivers stark warning on AI potential to turn an ordinary downturn into a severe economic crisis. Before I dig into the article, and I want to play one more video, Mitch, but what are your thoughts so far about what you saw as far as those AI layoffs? Do you see that continuing?
Yes. Because AI, like as I said a few videos back, what exactly do you not understand on the definition of artificial intelligence? It's not artificial and it's not intelligent, right? It's a 1 and a 0. It's a digit. And if it was so great, then why does all of us keep getting spam phone calls? If it was so great, in reality, it's nothing more than hype. Why is it hype? Well, it's no different than saying, what's the difference between a loan shark and a hard money lender? They're one and the same. So what they've done is taken a computerized process, which is perfectly fine. And in certain instances, it does good things. But the bottom line is they put a spin on it, a package, and look at the billions that have been created on the spin. And that is pump and dump. So the underlying point being that if we can explain to people who's preaching to you, what are they saying, and what's the math under the hood, then you start to understand that, yeah, this is being done for a reason, and you're being induced. That's the reason. So the trick is not to fall into the trap of being induced into doing something. It's like people are going to say, well, we're going to jump into the market right now because it's a pullback. Well, if you don't know what you're doing and you're not a trader, you're going to be the dead meat.
Yeah, and the good thing about math, Mitch, is math allows us to not have to trust people.
And that's welcome to my world.
and that's why I keep, I get bombarded with trolls. They're like, you're doing this for this reason, you're doing that for that reason. I'm like, oh, you know what I'm thinking, huh? Did you lose everything? Do you care about people like I care about people? Are you putting your money where your mouth is? I don't think so. Anyways, the whole situation is crazy. Let's play this video real quick.
It's extremely tight, with employment increasing by 6.5 million jobs from the middle of 2021. This increase in labor demand was met in part by workers rejoining the labor force as health concerns began to fade. But labor supply remained constrained. And in the summer of 2022, labor force participation remained well below pre-pandemic levels. There were nearly twice as many job openings as unemployed persons from March 2022 through the end of the year, signaling a severe labor shortage.
So according to Jerome, I mean, we're coming out of a massively strong, unnaturally pulled forward from the Fed and stimulus and PPP and EIDL loans. We're coming out of a strong labor market. And I think that's confused a lot of people, Mitch. And I've explained to people like, you guys, we need a little bit more patience, because remember, this labor market was one of the strongest labor markets we're coming out of, but it was not natural. It was unnatural. PPP, again, EIDL. So as a result of those things and no more money printing, no more stimulus, obviously we're starting to see cracks. Now here's an article, and I like how they break this down. Tech sector layoffs surge. Are more job cuts coming on the horizon? And I'm going to read a few things here, and I want to get your reaction, Mitch. This marks a significant continuation of the trend from 2023, during which 264,000 tech workers lost their jobs. Industry analysts attribute this resurgence, again, because it's resurging again, to lingering challenges from last year, forcing tech giants to overhaul their business models, streamline operations, and intensify their focus on artificial intelligence. Now, this goes on. The extent of layoffs and investor influence. With the scale of these layoffs growing, many are questioning which companies might be next and what factors are driving these decisions. Although the tech sector saw significant job cuts in 2023, experts, and here's the thing, and I highlighted this, did not predict. The reason they're not predicting this is because, remember, they're paid to get you to spend money. So there will always come back to their financial bias. That's why it's so important that I tell you guys that I don't charge you money. I don't want to be financial biased. The minute that I'm paid to speak a certain message, everything turns corrupt. Everything turns corrupt. So they did not predict that to happen in 2024. Now, it goes on. While the labor market in IT has shown some signs of recovery, has it? Or more print, bailout, whatever, stock market rally, post-pandemic and recession that are emerging signals of instability. A report by the Information Technology Industry Association in the U.S. Bureau revealed that unemployment in IT sector had reached 3.7%, and that's June 2024. That's the highest level since basically lockdowns at 4.6%. Now, companies impacted by job cuts in the first quarter of 2024 alone, this is crazy, Mitch, tech companies announced 100,000 workers to be laid off. All right. So it's continuing in the house, in the stock market hasn't even crashed yet. We haven't even gone into a technical depression or recession yet. And they're getting destroyed, Mitch. They're getting destroyed, whether it's them, it's because it's crappy technology or it's replacing their jobs. They're literally making something to replace them. Literally making something to replace them. Now, notable companies such as Alphabet, Meta, Amazon, TikTok, Tesla, Microsoft were among the first to announce job cuts. The Guardian reported that Google has already let go of more than 1,000 employees this year across its hardware, advertising sales, and search divisions. This follows the 12,000 jobs the company cut in 2023. And so this goes on and on and on, how, they're restructuring, how it's pretty much hitting everyone. Now, a couple factors, and again, this is why I'm really looking forward to your interpretation, Mitch, because you articulate things in a way that it just hits my soul, man. It just hits home. I mean, I view you as an honest person, and and that's why I love working with you, Mitch. Like, I don't have to really, I always verify. I verified. But my God, man, I mean, it's so refreshing to not have to talk to someone with some hidden motive or bias and trickery and sorcery. Anyways, factors behind the layoffs, several key factors that prompted the mass layoffs in the tech industry in 2023 continue. They continue to influence staffing decisions this year. Chief among them is the integration of AI into business operations. Research from the firm Gary and Christmas, it wasn't Christmas for those layoffs, people, found that AI was directly responsible for 800 layoffs in April alone. That's the highest monthly figure since May 2023. So obviously what they're saying, Mitch, is that's going to accelerate. Can you give me your interpretation of what's happening there? Do you think that a lot of these tech companies went too heavy on AI, maybe hired too many people, put too much faith, too much resources, too much money into it, and now what we're seeing is an unwinding that will help lead to a collapse in the labor market? I mean, I'm going to straight up ask you, Mitch, is all of this combined going to lead into a collapse in the labor market?
Yeah, let's break this down for a second. So understand what AI is and understand who's doing it. It was hype from the word go. Who did it in reality are nothing more than software vendors. They create the software, they sell the software. That's what AI is. It's software. It's literally no different than buying a box of Microsoft and say, I'm going to use this on my Dell computer. So it's software. Again, they took something and they packaged it and they called it AI, to the point where you even had oil firms, well, we're going to switch to AI, and their stock ran 30% in 2 days. It literally had nothing to do with AI. It was pure hype. So when you get down to figuring out how to look at this as to how bad it's going to be in the AI industry, well, you're always going to have good software engineers who need to be employed, and they're going to come up with stuff. And that's perfectly fine. That's great. But the reality is, what the companies should be looking at, those who are doing the investing, is what is the revenue per employee? Now you know that you've got a legitimate company and something that isn't hype. So if your revenue per employee, like in the case of Apple, is about $2.5 million per employee, okay, that's real math. That's real numbers. If in an AI company, and it turns out, well, we're only making 50,000 or 100,000 per employee, yeah, that's good math, but we got a real problem because the company isn't sustainable. And therefore, you now have all these layoffs that are occurring. Over and above that, what really drove it, in addition to the hype, was the Federal Reserve pumping M1 and M2 money supply. Like I said, that amount of money was in the trillions that's been sloshing around. Well, investors have to put that money, the investors, be it Goldman Sachs, Morgan Stanley, et cetera, what I would call the institutional investors, they've got to put that money somewhere. So they back the hype. They drive the hype up, and it comes right back to the theory of pump, where you're going to drive it up and then dump. We're going to take the puts before anybody even knows we're buying puts, and they'll catch the money on the way down.
I have a good one for you. All right, if you can, okay, try to articulate this and explain, Mitch, how would a collapse, okay, and massive layoffs in AI, how would that transition to other sectors in the economy that maybe have nothing to do with AI, and how would that cause layoffs? How would that spiral into other sectors outside of AI, and essentially a domino effect? How does that how do we get there, Mitch?
Well, in theory, there would be a Chinese firewall between the issue of the AI versus additional unemployment occurring. The problem is that the price to earnings ratios, when you're north of 15 on a PE, you seriously have got to look at what you're investing in. Well, you've got tech companies out there right now today that are 120 PE. So it's based on a future that is highly unlikely. So you put a probability to it, and I haven't run the probability, but I put it, let's say less than 2%, just off the top of my head. So no matter how you slice it, it really does come down to what is the revenue per employee and what is the ability of that company to be able to produce returns over, let's say, the next 5 to 10 years. And then you know that you've got something. But past that, when you enter into a market where there's so much money sloshing around and pushing these PEs to the point they don't make any sense, and then looking at the market today, as we speak right now. So yeah, I mean, there's a good probability that we're going to hit an all-time high and a double top. But it doesn't mean, here, look at it this way. Price is what you pay. Value is what you receive. If you buy into this market right now today and you buy into the hype, what value are you receiving when the probabilities are much greater to the downside than they are to the upside?
I mean, it's so well said, man. I don't think people are buying value. They're buying trends. They're buying a movement, right? They're the value of the math.
They're buying hype.
That's so crazy. There's no value, man. I mean, again, we can find value in math. Now, take a look at this article right here. This is, and I'm just going to read the headline for you, Mitch, and I want to get your thoughts here. Now, basically, they're saying from there's a couple people, right? But the range is from 65% stock market crash to an imminent recession. Here's a roundup of recent high-profile bear forecaster. I have a bear behind me. I don't know. I mean, of course, you knew that. I talk about it all the time because I'm proud. But anyways, but Gary Schilling is saying, recession by year end means 30% stock market plunge, We have another one right here. John Husband says a 65% stock market crash wouldn't be surprising. Here's another one from BCA Research. A recession in early 2025 will cause a 30% stock market decline. I want to get your reaction here, Mitch, and then I'm going to show you a whole bunch of headlines that say the exact opposite. But can I get your reaction there? Do you feel like is it possible we can hit 65? Can you explain to the viewers how much is 65? First of all, do you know around about how many trillions of dollars that is?
Not that I mean to pick on anybody, but these are talking heads without the benefit of intellect. Anybody can get up there and make a prediction and say, well, this is what's going to happen. A, they do not know. B, I actually saw that article. Do you know there's not a stitch of math to back them up? So yet math exists and probabilities exist. So if you simply go to the NASDAQ, you can go and look it up, go and look up the NASDAQ futures live chart and go bring up an options chain and then bring up something called delta. Well, delta will tell you what the current probabilities of an event occurring within the next 30, 60, 90 days, just depending on what month you're looking at under NASDAQ. And when you look at those probabilities, what is the probability of a 65% pullback in the next 90 days? Well, it would be sub 1% based on the delta. So in other words, it's not going to happen. When the trigger occurs, and nobody knows what that tipping point is, and that's what I've been saying, you don't know what the tipping point is. So you have to look at things from a relatively shorter term basis because all these problems exist under the hood. The talking heads, I have zero sympathy for because you spew stuff to pump the opposite side of the market, right? You've got the pump and dump, and then you've got the people that are creating fear. Well, mom and pop, they're being played like a ping pong ball, back and forth and back and forth. And it doesn't accomplish anything except to stroke the ego of the talking heads who don't know what the hell they're talking about because the math is right in front of them and they don't even know it exists. And therein lies the problem. Pump and dump or the opposite end of the spectrum.
Mitch, maybe they figured out that math doesn't matter to most people.
For those who don't understand how to deal with the math that's right in front of them, that is a huge educational problem. Yes. But you can't fall prey to being kicked around like a ping pong ball, right? You can't live your life that the sky is falling, and you can't live your life being pumped up and being induced to do transactions that don't make any sense for you and your family. So the only way to get to the truth is understand what your personal balance sheet is and your personal income statement and take control of it and stop listening to these idiot talking heads that can't back up their mouth.
All right, let's talk about these talking head idiots real quick, just for the viewers. So here's one article. I'm just going to show you three, Mitch. Here's one right here. This is from Yahoo. All of this is recent, by the way. This is a headline. The labor market will not collapse. Citi Wealth CIO says. Again, I look, okay, who is it? Oh, it's Citi. Citi's a bank. Oh, banks want us to spend to the end. But that's one headline. Here's another headline right here. U.S. unemployment claims fall 7,000 to 227,000 in sign of resilience in the job market. Wow, what a resilient job market. How isn't it amazing how we're not making as much money as we were? How's that resilient? Here's another one. This is crazy, Mitch. Again, look at this is from yesterday. Consumer confidence reaches 6-month high, but labor market worries rise. So, I'm saying I could feel Main Street feels this. So on one hand, Main Street feels this, but this is saying, and I don't know if that survey is true, but that's saying that consumers don't care. That's saying that consumers aren't worried about the math. That's saying that consumers are going to go out this weekend on a holiday weekend and they're going to spend like there is no tomorrow, Mitch. You want to break those three articles down, buddy? Do you agree with them?
There may be a stitch of truth in that because mom and pop that don't have the education and are just going to follow the Joneses and spend till the cows come home. Well, they're not your viewers to begin with. Your viewers actually care as to what's happening. So those people who don't care and aren't willing to take the time to get educated, understand what's going on right in front of them, yeah, they got a problem. So there may very well be a stitch of truth in that. However, the opposite end of the spectrum on the first two clips that you just showed there, the first two articles, is that, as I said before, if you want the truth, go to a grocery store. Start asking people, how do you perceive the market? How do you perceive this inflation? Then you get to the truth. Then, as we've said multiple times through these videos, you've got manipulation, straight up lies of the actual employment, because what they did is they moved the goalposts. Well, we don't want to take into account people that have 2 jobs. We don't want to take into account people that have 3 jobs. So we're only going to report this one segment of the market in this one geographic vicinity of the United States, and we're going to ignore probably 95% of the rest of the planet. Well, okay, you move the goalposts, and in fact, you're creating a fraud on the public. So it comes back to the same thing. You've got to understand and break it down as to what somebody is telling you and relate it back to yourself, and then you get to the truth.
Well said, man. Well said indeed. So, obviously the labor market's collapsing. All you have to do is look at the math, look under the hood, look at government jobs, look at any historical data that says, hey, future citizens, this is what you should watch out for. This is what we learned during this time of recession. I mean, we have these people warning us, and we have the math. Now let's end out here. I want to play a video. This is going to be from Jerome Powell. He's going to be talking about rate cuts, and I want to get you. I want to finish up here, Mitch, by getting your opinion on the rate cuts and whether or not those rate cuts are going to track layoffs. Honestly, I think they are going to track layoffs. I'm interested to hear what you have to say. Let's listen to this video.
It has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. We will do everything we can to support a strong labor market as we make further progress toward price stability.
Short and sweet, right? But the market, because of Jerome Powell, because of him, thinks that there are going to be rate cuts in September, 1/4 point, 50 point. But my question to you, Mitch, is first of all, I don't really care. The only reason I care about rate cuts is because of the psychology, right? Like I want to understand how much money consumers have left, because we know consumer spending is emotional. And so when everyone's like, oh yeah, the rates are going down, it's time to buy again. I'm interested to see how much purchasing power is actually left. But, do you think that those September rate cuts will happen? Do you think it's 50, 25? And do you think that will help consumers? Do you think that rate cuts will stop layoffs?
No, not at all. It's not going to stop layoffs whatsoever. Layoffs occur because the companies can't generate the revenue. It's that simple. So you have to have the revenue, you have to minus your expenses. Interest rates are part of the expenses, because if interest rates are up, then your expenses are up. It helps potentially the companies stay afloat, but it isn't going to stop the layoffs, right? It's like dancing on a razor blade. So what you mentioned is the population. Well, 37% of the households, we've already proven, can't afford the roof over their head. So they clearly don't have the money to spend. 67% of the households are up to their eyeballs in the debt. They're not quite as in bad position as 37% of the households, but that proves that there is no money. So those people who are out spending money are not necessarily in that 37%. But the point of the matter is they don't have the money. And as we've said on the CADs, that's going to cause a huge downfall. When people start losing their homes, the ramifications of that, it starts to jump. Right? The amount of unemployment gets less. So unemployment is going to move up. People are going to lose their jobs. The revenues are going to start going like this. It's a circular argument. It's like saying one hand washes the other, right? If everybody was on board and everything was going properly without the interference of the Federal Reserve, in other words, as I said before, chain the doors on that thing. Yeah. But that's not the reality in today's world yet. But had they have not been monkeying with these interest rates and let the market handle it to begin with, instead of backstopping the banks, that would be a huge benefit to mom and pop securing their own personal balance sheets. The manipulation and the inducement by virtue of the Fed monkeying with these interest rates is why we are where we are. So as I said the other day, look at the Fed. When they're saying now we're going to lower interest rates, well, it's a couple things. One of which is it's a political move. Look at the timing. Second of which is if they lower the interest rates, which he's going to be accommodative, and he said it, we don't know what's going to happen, but he said it, we're going to be accommodative. Okay, fine. But what is that signaling to everybody else? Well, it's signaling that the economy is not in good shape. It's signaling that all these reports that have come out are complete BS, and it was a pump and dump. It was designed to keep the market being pumped up, but now when they start to watch what happens. If they drop 50 basis points at one shot, You watch how fast this market reverses.
I mean, this is crazy. This is an unnatural value increase. It's unnatural.
It's straight up manipulation.
Yeah. I mean, it was through lockdowns. I mean, this whole thing is unnatural. That's why I'm like, man, if only that we didn't have so many bulls and we can actually come together as a society to fix this together, not trick each other until someone loses everything, because that's what's happening right now. And I want to just end here, Mitch. I want to talk to the average person, and I want you to let them and I, everyone know whether or not you would agree with me. And here's what I would like normal people, to do, Mitch. First of all, don't give up hope. I've lost everything already. I've had a foreclosure, bankruptcy, repo, and a 6-digit tax lien that followed me around for 9 years. Okay. But if I would have just changed my life and my spending habits and my mindset and my attitude and removed the apathy that I had for the way things worked, I would not be where I'm at today. I would be a millionaire, you guys. I would not have had my bankruptcy 6 months. That's it. And I'm telling you that because it's not too late to change your life. And really, this is what I'm saying. Okay. This is what do you do with all this information? You save your money. You save your money. You understand that what's coming in the future is a lack of easy money, a very difficult market to get a job in. If you understand those things, and even if it doesn't happen, if you prepare for that, you will be ahead. So again, save your money. One of the biggest things we could do is rebudget. In order to save money, we have to rebudget. I know you have subscriptions. I know it. I know you do. And I know you're going out to eat. Stop those things. I canceled almost all of my subscriptions. I don't even have Bloomberg, Fortune, Market Watch. I mean, I canceled them all, Mitch. I canceled them. And improve credit. Understand your market. I've been watching my real estate market like the back of my hand for over 2 years, man. I know all the stuff that's going on in my subdivisions. I'm ready, man. I am equipped. What I've done and what I'm hoping the viewers are going to do is equip yourself, strengthen yourself, because we're about to go to war, right? Learn how to use the equipment that I'm giving you, the credit, the income, the assets, so that we can go to war together and we can win together. And you guys, we have a lot planned for 2025. We're going to knock these CADs out, man. We're going to bankrupt them. We're going to fix this system. That's a video for another day. I know I'm getting a little excited, Mitch. I'm working on the classes, guys. I mean, we're giving back. In my mind, guys, the reason why we're doing this is I want to do God's work. I want to do God's work. And that's who I am. Mitch, any thoughts on that, man?
I think it's a matter of mom and pop, of which we all are at the tail end of the day. Even though people work for large corporations, they're people, and people are mom and pop. So understanding what's happening around you to enough to understand that you're being induced is probably 80% of the battle. If you know you're being induced, you can simply dig your heels in and say, I'm not going to participate in this. I don't want to know about it. And then over time, you'll begin to realize, well, I can make a very safe investment, stay away from the pension funds, and I can invest in an index, et cetera, and I can get a yield. And we'll explain that shortly coming up. But it really is about adding clarity to your life and not being induced by all these articles and being kicked around or hit like a ping pong ball, because there's two sides to these markets and both sides are extreme, yet the truth lies somewhere in the middle, dealing with the markets as they are. And in the case of the CADs, we'll get into that and explain what the economic damage is. And if you can avoid it simply by going to the CADs and saying, I'm not going to do this and I'm going to protest, very shortly, probably in the next video or so, we're going to lay out for you exactly how much money you will have by doing that.
Yeah. And that's on me, guys. Like, Mitch is ready to go. I'm like, Mitch, I want to have 4 chapters filmed first. So in that video, I want to show them, like, the people are getting burnt out, Mitch, of people over promising and under delivering. So I don't even want to do another video until I have that to show them, so that they know beyond a shadow of doubt that we are at least trying to make a movement and trying to improve society. All right. I'm not trying to get rich. I'm not trying to take over the world. I'm trying to survive, though, obviously, right? I have children, I have to survive. But I love what we're doing, Mitch. I do. I feel like what we're doing in the movement, as long as people are listening and as long as people help themselves, right? Yeah. That's what we're asking. We're asking people to help themselves, cut back a little bit. And then, other than that, just follow us, follow the training and education that is right around the corner. In fact, I already have a course. It's a beautiful course. It's a great course. I already have it. You guys, we're gonna bring you guys with us. We're gonna grow together. We're gonna stay united, and we're gonna make a positive change. And that is right around the corner. And other than that, guys, comment below. Let us know how you feel. I really appreciate your time, Mitch. I thought this was a great video full of overwhelming value. And guys, if you're out there investing in real estate, you should probably stop. But regardless, we hope you win.